During the pivotal years of 1914 to 1918, the global banking system embarked on what can only be described as the most extraordinary financial undertaking in recorded history. It monetized over $200 billion, an astronomical sum at the time, through unprecedented credit expansion to finance the world's first truly industrial conflict. This monumental effort fundamentally reshaped the very essence of banking, transforming institutions once known for their conservative practice of lending existing deposits into formidable money creation machines. These new entities were capable of funding unparalleled government spending through sheer monetary expansion, a paradigm shift with lasting implications. This wasn't merely a matter of issuing war bonds or appealing to patriotic citizens for loans. It represented a profound, systemic overhaul of the fundamental mechanisms through which money functioned and was created within the economy. Prior to 1914, banking operations were tightly constrained by the tenets of the gold standard, which inherently limited their capacity to generate credit. However, the relentless demands of total war irrevocably shattered these long-standing, seemingly inviolable limitations. This unprecedented pressure compelled financial institutions to rapidly innovate and deploy revolutionary financing techniques, ultimately reconfiguring the landscape of capitalism for generations to come. To grasp the magnitude of this transformation, one only needs to look at the financial maneuvers of the major powers, figures so vast they defy conventional comprehension. Great Britain, for instance, accumulated over £6 billion in debt during the conflict, a sum that remarkably surpassed its entire national economic output prior to 1914. Germany financed the war by expanding its cash circulation by nearly 600%, reaching over 33.1 billion marks by the end of 1918. The United States, having entered the war with a negligible federal debt, exited with obligations soaring past $25 billion. Across the board, from France and Russia to Austria-Hungary, every major power financed its colossal military operations through a degree of monetary expansion that utterly dwarfed any financial undertaking ever conceived before. Crucially, what often remains unexamined and largely misunderstood is the intricate behind-the-scenes orchestration of this financial revolution. Central banks, in a radical departure from established norms, systematically abandoned gold convertibility, simultaneously conjuring new money specifically to acquire vast quantities of government bonds. Commercial banks innovated by forming lending syndicates on scales previously unimaginable. Investment banks, seizing the moment, pioneered the mass marketing of government securities, effectively transforming them into popular investments for ordinary citizens. Furthermore, an entirely new ecosystem of shadow banking systems materialized, designed to manage transactions deemed too enormous and intricate for conventional financial institutions to handle. This overlooked narrative of wartime finance illuminates the astonishing collaboration between leading bankers, central bank governors, and treasury officials, a concerted effort that effectively forged the foundational architecture of the modern financial system we operate within today. Indeed, virtually every significant innovation in 20th century banking, ranging from the systematic monetization of unbacked government debt to the establishment of mass retail securities markets, found its genesis during World War I. These breakthroughs were not born of foresight, but rather of desperate necessity, compelled by military operations that devoured resources at rates utterly unimaginable to any peacetime economy. Ultimately, this narrative details how 4 intense years of industrial warfare irrevocably transformed banking from a staid, conservative profession into the dynamic engine of perpetual monetary expansion. In doing so, it created both the innovative techniques and the enduring institutional frameworks that would go on to finance every subsequent government expansion, navigate countless economic crises, and fund every major military conflict for the entirety of the following century. The profound overhaul of global banking systems witnessed between 1914 and 1918 stands as one of the most dramatic and far-reaching institutional metamorphoses in economic history. It marked the decisive abandonment of the strict gold standard constraints and the conservative practices that had meticulously governed international finance since the late 19th century in favor of unprecedented fiat monetary expansion and sweeping government financial intervention. These shifts would not only redefine, but permanently reshape the global economic order. In the era preceding World War I, international banking functioned according to a set of well-established principles, meticulously refined over hundreds of years of commercial and financial evolution. At their core, banks primarily served as intermediaries, diligently channeling the savings of their depositors to various borrowers. Governments, for their part, typically funded extraordinary expenditures through conventional taxation or by soliciting loans from existing pools of wealthy individuals and institutions. While central banks like the Bank of England strictly adhered to gold convertibility, they were not entirely passive. Since the mid-19th century, they had developed sophisticated liquidity intervention mechanisms, actively acting as a lender of last resort based on Bagehot's principles during financial panics, though the scale of these operations was dwarfed by the impending storm of World War I. The paramount gold standard imposed inherent and automatic constraints on both government spending and the creation of bank credit. Any significant monetary expansion, if deemed excessive, would inevitably trigger gold outflows, thereby compelling an immediate and often painful policy reversal. Despite its rigidities, this system successfully enforced monetary discipline and anchored long-term price expectations, even if it occasionally caused secular trends of deflation and mild inflation. Crucially, it facilitated the emergence of the first truly global economy through standardized monetary relationships and automatic balance of payments adjustment mechanisms. Commercial banking relationships in this era were largely predicated on personal acquaintance and robust local connections, with the majority of banks primarily serving regional markets and upholding conservative lending standards that directly mirrored the finite pool of depositor funds available for loan expansion. International banking, by contrast, was an exclusive domain, dominated by a select consortium of prestigious merchant houses that specialized in complex trade finance and the distribution of government bonds. These elite firms operated through intricate networks of personal relationships and long-standing correspondent banking agreements. Government finance itself adhered to predictable patterns, honed over centuries. Peacetime budgets were meticulously balanced through taxation, while exceptional expenses, such as wars, were financed by securing loans from affluent individuals and established institutional investors. The scope of government borrowing was inherently constrained by the finite amount of private wealth that could realistically be mobilized for public objectives. Furthermore, the capacity to service this debt was strictly limited by a government's ability to raise taxes without provoking widespread economic disruption or significant political opposition. However, the cataclysmic outbreak of war in August 1914 instantly decimated these traditional financial arrangements, as the sheer magnitude of projected military expenditures quickly outstripped any conceivable level of taxation or conventional borrowing. The immense scale and protracted duration of the unfolding combat operations necessitated financial resources that far exceeded the capacity of any extant institutional frameworks. Indeed, the conventional structures of banking and government finance proved utterly inadequate for sustaining industrial warfare, a conflict model that devoured materials, equipment, and human resources at truly unprecedented rates. Military spending requirements dramatically eclipsed all prior government expenditures. Major powers were soon spending between 10 and 20 times their pre-war budgets, and these staggering levels had to be sustained for years, not mere months. To illustrate, the British government's daily outlay surged from approximately £500,000 during peacetime to well over £5 million amidst active warfare. Similarly, German military expenditures escalated from 2 billion marks annually before the war to more than 15 billion marks by 1917. Identical patterns of explosive spending characterized every significant belligerent power. The glaring inadequacy of traditional financing methods became painfully evident within just months of the war's commencement. Initial attempts to fund military operations through conventional taxation and bond sales, primarily targeting existing wealthy individuals, proved woefully insufficient to meet the monumental scale of resources that modern warfare imperatively demanded. It became unequivocally clear that entirely new financial techniques and institutional arrangements would be indispensable to effectively mobilize the vast economic resources required for total war. In response, central bank policy underwent a revolutionary and seismic transformation. Monetary authorities decisively abandoned the rigid constraints of the gold standard, instead embracing aggressive currency and credit expansion explicitly designed to underwrite massive government borrowing and facilitate comprehensive economic mobilization. Most notably, the Bank of England effectively suspended gold convertibility for internal circulation within days of the war's outbreak, a drastic measure not seen since the suspension period of the Napoleonic Wars over a century earlier. Similar decisive actions by other central banks worldwide signaled the definitive collapse of the international monetary system that had meticulously governed global finance since the 19th century. Concurrently, commercial banking practices underwent a swift evolution to accommodate government financing requirements that drastically surpassed all prior experience. Banks rapidly developed sophisticated syndicate lending arrangements, acquired government securities using deposits they themselves had newly created, and actively participated in extensive mass marketing campaigns. These campaigns fundamentally democratized government bond ownership, shifting it from an exclusive preserve of the wealthy elite to a widely accessible and popular investment instrument for the general populace. The groundbreaking financial innovations forged during World War I not only established critical precedents, but also built enduring institutional capabilities that would profoundly shape government finance and monetary policy throughout the remainder of the 20th century. Specifically, the novel techniques of central bank money creation, the unprecedented scale of mass government borrowing, and sophisticated methods of financial market manipulation, all pioneered under the duress of war, provided powerful new tools that governments would continue to wield for economic management long after the immediate military emergency had subsided. International financial relationships were fundamentally and permanently reshaped. The war's immense financing demands created entirely new creditor-debtor dynamics, even among former allies, simultaneously shattering the delicate currency stability and automatic adjustment mechanisms that had underpinned the thriving pre-war global economy. The United States, in particular, emerged from the conflict as the unquestioned dominant creditor nation, while the exhausted European powers found themselves saddled with colossal debt burdens that would severely constrain their economic and political development for decades to come. While every nation adapted, no country's financial trajectory offers a more striking illustration of this evolution than the German Empire. To truly grasp the evolution of modern government finance and the monetary systems we know today, it is imperative to delve into the specific innovations and profound institutional changes that the sheer exigencies of war financing imposed upon banking systems. These systems had, until then, operated under entirely disparate principles and constraints, making the forced adaptations particularly telling. Let us begin by examining the German system. Germany's financial mobilization during World War I vividly illustrated both the inherent strengths and latent vulnerabilities of the continental European banking model. Its distinctive universal banking system, combined with state-directed economic policies that had historically fueled rapid industrial development, demonstrated an astonishing capacity for wartime resource mobilization. However, this came at a significant cost, ultimately generating severe inflationary pressures that would gravely undermine currency stability and economic effectiveness. The German financial system's initial response to the demands of war mobilization unveiled sophisticated institutional capabilities, meticulously honed over decades through state-supported industrialization and meticulous military preparation. The Reichsbank, Germany's central bank, possessed substantial gold reserves and had maintained conservative monetary policies, thus establishing a robust foundation for currency stability that initially allowed Germany to finance its military operations without immediate financial dislocation. The universal banking arrangements, which were a hallmark of German finance, offered distinct and invaluable advantages for the nation's comprehensive war mobilization efforts. Major institutions such as Deutsche Bank and Dresdner Bank seamlessly integrated commercial banking, investment banking, and industrial finance within single, expansive organizations. This unique structure afforded them the unparalleled ability to rapidly redirect both financial and industrial resources towards military production. Such comprehensive and interwoven relationships facilitated a coordinated mobilization of the nation's economic power that more specialized, fragmented banking systems simply could not replicate. A pivotal institutional shift during the war was the dramatic transformation of the Reichsbank itself. From its traditional role as a conservative central bank, it mutated into an active and aggressive financier of government operations. Its officials systematically jettisoned the constraints of the gold standard, instead embracing a policy of virtually unlimited currency creation, meticulously designed to underpin massive military spending. Intriguingly, this radical transformation unfolded somewhat gradually, implemented through a series of subtle policy adjustments that shrewdly maintained a facade of fiscal responsibility, even as they enabled truly unrestricted government borrowing. German financial authorities ingeniously developed sophisticated government borrowing techniques that encompassed innovations in bond marketing, strategic institutional sales, and comprehensive public financial education. These efforts successfully mobilized savings from previously untapped segments of the population, all while meticulously cultivating and maintaining public confidence in the government's financial management. The remarkable success in selling war loans to ordinary citizens strikingly demonstrated how potent patriotic appeals could effectively override traditional German saving preferences, which typically favored secure bank deposits and tangible real estate investments. Furthermore, robust industrial finance arrangements, which forged direct and strong connections between banks and manufacturing enterprises, were instrumental. They facilitated the rapid and seamless conversion of civilian production capabilities to military purposes, all while concurrently sustaining the critical capital investment and technological development essential for continuous war production. These tightly interwoven relationships served as influential models for state-directed economic development, patterns that would continue to shape German economic policy throughout the entirety of the 20th century. Despite the abandonment of gold convertibility, Germany's currency management policies remarkably managed to sustain the mark's international acceptability. This arduous feat necessitated sophisticated diplomatic and financial arrangements with neutral countries and crucial trading partners. German financial authorities innovated extensively, developing pioneering techniques for actively supporting exchange rates through strategic trade policy, judicious bilateral agreements, and carefully orchestrated currency manipulation, effectively laying the groundwork for modern exchange rate management practices. The concurrent development of shadow banking arrangements was crucial for handling transactions that proved too immense or intricate for conventional institutions. This involved the ingenious creation of special-purpose vehicles specifically designed for government borrowing, industrial finance, and international trade. Operating largely beyond the purview of normal regulatory oversight, these structures afforded an essential degree of flexibility and secrecy, both of which were absolutely vital for the nation's military and economic planning during wartime. Effective regional banking coordination across the vast German Empire demanded the intricate integration of the financial systems of its constituent states, all while meticulously preserving local institutional autonomy and existing political relationships. This complex coordination successfully demonstrated how sophisticated federal financial arrangements could robustly support centralized military planning without sacrificing the essential integrity of regional economic and political structures. Crucially, international trade finance arrangements were innovated to sustain German commercial relationships even amidst the raging military conflict. This involved the creation of ingenious alternative payment systems, novel currency arrangements, and flexible credit facilities. These mechanisms enabled continued commerce with neutral countries, critically ensuring the financing of essential imports of raw materials and vital food products, which were indispensable for the war effort and domestic survival. Inflation management presented an increasingly formidable challenge as virtually unlimited government borrowing fueled a relentless monetary expansion that gravely threatened to undermine both currency stability and meticulous economic planning. In response, German financial authorities devised sophisticated techniques specifically aimed at managing public price expectations and controlling outwardly visible inflation. This was done even as they simultaneously enabled continued, substantial monetary expansion to maintain critical support for ongoing military operations. Banking regulation underwent a dramatic and unprecedented expansion as government authorities asserted direct, pervasive control over critical functions such as credit allocation, foreign exchange operations, and the securities markets, domains that had previously functioned largely according to laissez-faire market principles. These sweeping regulatory innovations established powerful precedents for comprehensive government oversight of financial operations, compellingly demonstrating how acute crisis conditions could, in practice, justify an unparalleled expansion of state economic authority. Corporate finance arrangements tailored to support burgeoning war production incorporated various novel mechanisms, including direct government equity participation, extensive guaranteed loans, and strategically directed investment policies. These initiatives forged entirely new and intimate relationships between the state and private enterprises. Crucially, These arrangements established influential models for the development of mixed economy structures, which would continue to profoundly shape German economic organization for many years beyond the cessation of hostilities. Resource mobilization, orchestrated primarily through financial mechanisms, involved ingenious techniques for converting private savings directly into government spending, all while striving to maintain essential incentives for continued work and robust production. The development of forced saving programs and stringent consumption controls vividly illustrated how sophisticated financial policies could be deployed to support a comprehensive total war mobilization, even as authorities simultaneously endeavored to maintain a semblance of domestic economic stability. Furthermore, innovative labor finance arrangements, encompassing strict wage controls, expansive savings programs, and embryonic social welfare policies, demonstrated the critical role financial institutions could play in supporting comprehensive economic mobilization. This was achieved while concurrently striving to maintain worker cooperation and broader social stability. These programs not only established significant precedents for the future development of welfare states, but also strikingly illustrated how financial mechanisms could be purposefully leveraged to serve broader social and political objectives beyond mere economic efficiency. The financing of technology development through close government and banking partnerships proved vital, enabling sustained innovation and continuous production improvement despite severe resource constraints and overwhelming military priorities. These pioneering arrangements powerfully demonstrated how financial institutions could effectively support technological progress even under acute crisis conditions, all while striving to safeguard long-term economic development capabilities. Furthermore, international financial warfare tactics, including strategic currency manipulation, deliberate trade disruption, and stringent credit restrictions, clearly demonstrated how financial capabilities could be deftly employed to achieve military objectives while simultaneously exerting immense economic pressure on enemy powers. These innovative techniques established crucial precedents for the concept of economic warfare, practices that would subsequently become standard during future international conflicts. Throughout the German Empire, provincial banking systems exhibited remarkable adaptability and robust coordination during the intense wartime mobilization. Regional institutions not only successfully maintained vital local services, but also made significant contributions to overarching national financial objectives. This impressive coordination underscored the inherent effectiveness of decentralized banking systems in supporting comprehensive economic mobilization, all while diligently preserving crucial local economic relationships and structures. By 1916, the profound strain of this unlimited financial expansion began to manifest overtly in escalating currency depreciation and widespread commodity shortages. The inherent conflict between unchecked government spending and finite real resources inexorably generated immense inflationary pressures, which German financial authorities largely attempted to manage through administrative measures and public communication campaigns, rather than resorting to genuine fiscal discipline. By the end of 1918, German government debt had surged to levels that dramatically exceeded the economy's capacity to service through conventional taxation. Simultaneously, currency depreciation accelerated relentlessly, despite strenuous official controls and pervasive propaganda efforts. While the financial system's remarkable mobilization capabilities had indeed facilitated unprecedented military endeavors, they concurrently sowed the seeds of profound monetary instability that would critically contribute to Germany's severe post-war economic and political crises. But before we witness this radical transformation, we must first look back at the world that was lost, the sophisticated, gold-backed stability of the pre-1914 era. The international banking system that prevailed in 1914 was the zenith of centuries of meticulously refined financial evolution. It was fundamentally characterized by deep institutional conservatism, rigorous adherence to gold standard discipline, and a notably limited degree of government involvement. Yet this intricate system would ultimately prove profoundly inadequate for confronting the unprecedented financial demands that industrial warfare was about to impose upon the global economy. The outbreak of the war triggered a global financial panic, leading to the closure of international stock markets, including the London Stock Exchange, for 5 months. In the United States, European investors held over $4 billion in American securities, and the looming fear that they would aggressively sell off these assets to repatriate gold threatened to drain the nation's reserves. To prevent a catastrophic gold drain, U.S. Treasury Secretary William G. McAdoo ordered the New York Stock Exchange to shut down on July 31, 1914, an unprecedented suspension that lasted for 4.5 months. During this time, a substitute trading forum known as the New Street Market emerged to provide necessary liquidity to investors. Furthermore, contrary to the belief that the newly created Federal Reserve provided immediate stability, the central bank was not yet operational in the summer of 1914. It was McAdoo who saved the U.S. banking system from collapse by invoking the Aldrich-Vreeland Act of 1908 to issue emergency currency, successfully preventing a banking panic. Only after the Federal Reserve banks officially opened in November 1914 did the new central bank take over, eventually demonstrating its capability to manage the complex capital flows and currency pressures generated by war-related business. To understand why this panic was so seismic, one must examine the institutions that had hitherto anchored the global order, starting with the very heart of international finance. At the undisputed heart of this intricate system stood the Bank of England, widely regarded as the world's premier financial institution. It operated according to principles honed over centuries of practical experience, diligently upholding gold convertibility and providing the crucial international leadership that enabled the classical gold standard to function with remarkable effectiveness. The bank's substantial gold reserves, typically maintained at a robust 30 to 40% of its note circulation, formed the bedrock of international confidence in sterling, simultaneously cementing London's unrivaled position as the world's undisputed financial capital. British commercial banks operated through a sophisticated and extensive network of institutions meticulously evolved over time to cater to the complex needs of international trade and imperial finance. The Big Five clearing banks, Lloyds, Barclays, Midland, Westminster, and National Provincial, held dominant sway over domestic banking, yet concurrently maintained formidable and extensive overseas operations. These versatile institutions skillfully combined comprehensive retail banking services for their domestic clientele with highly specialized merchant banking capabilities, adeptly serving the realms of international finance and crucial trade credit. Illustrious merchant banking houses, such as Rothschild, Baring Brothers, and Hambros, specialized in the intricate world of international finance, expert government bond underwriting, and sophisticated trade financing. Their operations seamlessly linked British capital markets with diverse investment opportunities spanning the globe. These highly prestigious firms conducted their business primarily through deeply entrenched personal relationships and robust family networks, painstakingly cultivated over generations of intensive international commercial activity. The London money market, renowned for its sophistication, offered an array of intricate mechanisms for short-term finance and international arbitrage. These facilitated exceptionally efficient capital allocation while simultaneously upholding the critical currency stability and delicate interest rate relationships indispensable for the effective functioning of gold standard operations. The discount market, along with specialized bill broking and acceptance credit systems, provided essential financing for international trade, concurrently enabling banks to meticulously manage their liquidity and safeguard their profitability. German banking, in contrast, had evolved along distinct organizational lines, prominently featuring universal banks that seamlessly integrated commercial banking, investment banking, and industrial finance all within single, expansive institutions. Major players like Deutsche Bank and Dresdner Bank fostered exceptionally close relationships with industrial enterprises, offering comprehensive financial services that were instrumental in propelling Germany's rapid industrial development during the late 19th century. The Reichsbank functioned as Germany's central bank, diligently maintaining gold convertibility and managing the monetary policy that had undeniably facilitated Germany's ascendancy as Europe's preeminent industrial power. The bank's nuanced understanding of both international finance and the specific credit requirements of industry provided a robust foundation for Germany's emerging challenge to long-standing British financial dominance. French banking was squarely centered around the Banque de France and an extensive network of commercial banks that had historically provided the critical financial bedrock for France's burgeoning colonial empire and its sustained industrial development. The Banque de France's substantial gold reserves and its steadfast conservative monetary policies had successfully maintained the stability of the franc, simultaneously empowering French investors to finance industrial expansion across Europe and throughout the vast French colonial territories. Major French banks, including Crédit Lyonnais and Société Générale, had cultivated extensive international operations, specializing adeptly in government bond distribution and international lending, which collectively established Paris as a significant European financial center. Notably, French banks possessed a particular and deep expertise in Eastern European and Russian finance, a specialization that would prove strategically important during the impending conflict. In stark contrast, American banking remained largely fragmented and predominantly organized along regional lines. It notably lacked the cohesive central banking institution and the international sophistication that were defining characteristics of its European counterparts. The absence of a central bank frequently contributed to periodic financial instability, simultaneously curtailing the ability of American banks to effectively compete with established European institutions in the arenas of international finance and government lending. Nevertheless, American financial resources were expanding with remarkable rapidity. Fueled by robust industrial development and significant population growth, the nation was accumulating enormous capital, which increasingly began to seek international investment opportunities. Esteemed Wall Street firms, most prominently J.P. Morgan & Company, had, by this time, cultivated formidable capabilities in large-scale industrial finance and international lending, expertise that would ultimately prove indispensable during the impending global conflict. Russian banking presented a unique hybrid model, blending state-dominated institutions with private banks. These entities had largely financed the nation's industrial development and extensive railway construction, often with significant infusions of foreign investment. The State Bank of the Russian Empire meticulously maintained substantial gold reserves while carefully managing the monetary policy that had facilitated Russia's rapid economic growth during the early 20th century. Meanwhile, Austrian and Hungarian banks diligently catered to the diverse financial requirements of the sprawling Habsburg Empire's multinational economy, ensuring the currency stability that permitted the empire's participation in international commerce and capital markets. The Austro-Hungarian Bank, in particular, was charged with managing the complex monetary policy for one of Europe's largest and most intricate economies. International banking relationships were primarily conducted through intricate correspondent arrangements and highly personalized networks. These structures expertly balanced cooperation with competition, all while meticulously upholding the stability and predictability that the gold standard's operations fundamentally demanded. These deeply integrated relationships served as the essential mechanisms for facilitating international payments, seamless currency exchange, and fluid capital movements, collectively underpinning a truly integrated global economy. Banking regulation in most countries remained notably minimal. Financial institutions largely operated according to long-standing traditional practices and in response to natural competitive pressures, rather than being subject to detailed government oversight. This largely laissez-faire regulatory environment reflected a deep-seated confidence in the efficacy of market discipline and the inherent wisdom of conservative banking practices, which had historically fostered stability while simultaneously enabling robust economic growth and sustained financial development. Capital adequacy standards, rather than being enforced through formal regulatory requirements, were predominantly maintained through inherently conservative practices and the self-regulating forces of market discipline. Banks intuitively understood that excessive risk-taking could imperil their very survival, and that depositor confidence was inextricably linked to their perceived financial strength and demonstrable operational competence. Under the strictures of the gold standard, international capital movements flowed with remarkable freedom, effectively eliminating currency risks and thereby facilitating the highly efficient allocation of investment capital towards its most productive applications globally. These unfettered capital flows not only underpinned economic development across the world, but also forged deeply integrated financial relationships that, by their very nature, would transmit both periods of prosperity and moments of profound instability across national boundaries. Credit creation itself remained severely constrained by the stringent requirements of the gold standard and the prevailing conservative banking practices. These limitations effectively restricted monetary expansion to levels strictly consistent with maintaining currency convertibility and safeguarding depositor confidence. Critically, these inherent constraints had successfully prevented the kind of excessive credit expansion and rampant inflation that would become a defining characteristic of subsequent periods marked by unconstrained monetary policy. The profound sophistication and unwavering conservative principles that deeply characterized pre-war banking systems were the culmination of centuries of painstaking institutional evolution and invaluable practical experience. However, these meticulously crafted systems were fundamentally designed for the relatively tranquil economic relationships and predictable government financial needs of peacetime. They bore absolutely no resemblance to the colossal and unforgiving requirements that industrial warfare would soon brutally impose upon financial institutions and monetary authorities alike. By August 1914, the international banking system had indeed achieved a remarkable degree of stability and demonstrated exceptional effectiveness in supporting burgeoning global commerce and fostering economic development. Yet these impressive achievements were, tragically, built on foundations that would inevitably crumble when subjected to the utterly unprecedented pressures of financing total war between the world's major industrial powers. The sophisticated world of 19th century finance, so meticulously built on gold and trust, was about to face its ultimate trial. On June 28, 1914, a single event in Sarajevo ignited a fuse that would blow the foundations of global banking apart. The declaration of war in August 1914 immediately plunged the world into an unprecedented financial panic, a crisis so severe it threatened to utterly dismantle the international banking system within a matter of days. Investors, in a frenzy, desperately attempted to convert their securities and foreign currencies into gold, while credit markets seized up entirely and stock exchanges across the globe were forced to close their doors, all in a desperate bid to avert a complete collapse of the international financial order. Initially, the assassination of Archduke Franz Ferdinand on June 28, 1914, caused only a modest ripple of disruption in financial markets. Investors, long accustomed to recurrent political crises in the Balkans that typically dissipated without escalating into major military conflicts, did not immediately foresee the catastrophe. However, as the diplomatic crisis inexorably deepened throughout July, a palpable and growing anxiety permeated financial markets, as the grim possibility of a general European war became chillingly apparent. Austrian financial markets were the first to experience severe disruption. The Habsburg government's uncompromising ultimatum to Serbia triggered an immediate and frantic capital flight, coupled with intense currency speculation. This forced the Austro-Hungarian Bank to swiftly implement emergency measures in a desperate attempt to shore up exchange rate stability. The Vienna Stock Exchange, buckling under immense selling pressure, closed its operations on July 27th, amidst fears that burgeoning panic conditions could rapidly spread throughout all European financial markets. The London financial market, typically the bastion of global finance, then faced. Despite its renowned sophistication and international leadership, the London financial market was swiftly exposed to the burgeoning panic as European diplomatic relations dangerously deteriorated. A wave of foreign investors initiated a rapid liquidation of their British securities, concurrently demanding conversion into gold, a move that exerted unprecedented strain on the Bank of England's gold reserves. The London Stock Exchange, too, found itself deluged by intense selling pressure, threatening to completely overwhelm the traditional market participants' capacity to maintain orderly trading and liquidity. German financial markets vividly reflected the nation's comprehensive economic preparations for potential military conflict. The Reichsbank proactively began accumulating substantial gold reserves, while commercial banks, anticipating uncertain future demands, restricted their lending activities to meticulously preserve liquidity. The Berlin Stock Exchange, in particular, experienced considerable selling pressure primarily from foreign investors. In stark contrast, domestic confidence remained remarkably stable, largely bolstered by strong public faith in Germany's perceived military readiness and strength. French financial markets were severely disrupted by a massive outflow of capital, as discerning investors accurately anticipated France's inevitable involvement in any widespread European conflict. The Bank of France faced substantial gold outflows, compounded by significant deposit withdrawals from commercial banks, which collectively threatened to precipitate a severe liquidity crisis. The Paris Stock Exchange was consequently compelled to implement a series of emergency measures, including potential trading halts and price limits, in a desperate bid to maintain some semblance of orderly trading conditions amidst the chaos. Russian financial markets suffered an almost immediate and catastrophic collapse. Investors quickly recognized that Russia's vast military mobilization would necessitate colossal financial resources, far exceeding the empire's notoriously limited fiscal capabilities to provide through conventional means. The Russian state bank contended with massive gold outflows, while commercial banks promptly suspended their normal lending operations, hoarding cash for urgent emergency requirements. But the panic was not contained within national borders. It surged across the invisible veins of global commerce, paralyzing the very mechanisms of international exchange. The international foreign exchange market, which had previously operated with remarkable stability under the framework of the gold standard, plunged into unprecedented volatility. Investors frantically attempted to convert vulnerable national currencies into gold, or into the currencies of nations perceived as likely to maintain neutrality during the escalating crisis. Traditional arbitrage relationships, typically crucial for market efficiency, disintegrated entirely as market participants prioritized the desperate goal of capital preservation over fleeting profit opportunities. New York financial markets initially appeared to benefit from the profound European disruption. American investors swiftly repatriated their funds from overseas, while foreign investors, seeking safe havens, directed capital flight away from turbulent European markets towards the relative security of the United States. However, American markets eventually also experienced significant disruption as international payment systems fractured and credit relationships with European counterparts became increasingly uncertain and unreliable. The London money market, long regarded as the undisputed hub of international short-term finance, suffered a complete and utter breakdown. International credit lines were summarily suspended, and banks and discount houses faced overwhelming demands for cash, far surpassing their normal operational capacities. Traditional lending relationships collapsed entirely, as the rapidly changing conditions made it virtually impossible to accurately evaluate counterparty risk. International payment systems experienced severe and widespread disruption. Banks imposed stringent restrictions on foreign exchange operations, causing exchange rates to deviate wildly from their established gold standard parities due to enormous speculative flows. Letters of credit and other vital trade finance instruments became exceedingly difficult to execute, as banks increasingly questioned the creditworthiness of foreign counterparts and the fundamental stability of international monetary arrangements. Central bank cooperation, a cornerstone that had fostered international financial stability through informal networks and coordinated policies for decades, disintegrated. National monetary authorities, facing overwhelming domestic pressures, prioritized national interests over international coordination. The collaborative relationships that had diligently supported gold standard operations were regrettably replaced by competitive, often self-serving policies designed primarily to protect individual national financial systems. While the stock market closure addressed the external gold drain, the U.S. banking system still faced a severe internal threat of bank runs. Contrary to the assumption that the newly created Federal Reserve provided immediate stability, the central bank was not yet operational in the summer of 1914. Instead, it was Treasury Secretary William G. McAdoo who averted a financial catastrophe by invoking the emergency currency provisions of the Aldrich-Vreeland Act of 1908. This legislation allowed national banks to form currency associations and issue emergency currency backed by assets other than U.S. government bonds, such as commercial paper and warehouse receipts. By flooding the country with over $368 million in this emergency currency, the Treasury satisfied the public's frantic demand for cash and prevented a systemic suspension of deposit convertibility. It was only after the Federal Reserve banks officially opened in November 1914 that the new central bank took over, eventually managing the complex capital flows and currency pressures generated by war-related business. Commercial bank lending contracted sharply as institutions grappled with massive deposit withdrawals and simultaneously found themselves unable to accurately evaluate credit risks amidst rapidly shifting economic and political landscapes. Across Europe, banks suspended normal lending operations, instead concentrating on critically maintaining liquidity and prudently preserving capital for unforeseen future requirements. Government bond markets experienced massive upheaval. Investors demanded significantly higher yields to compensate for the escalating political and currency risks, while governments themselves confronted the daunting prospect of financing military operations that would far exceed their normal budgetary resources. Traditional government borrowing mechanisms proved utterly inadequate for the unprecedented financial requirements that a general war would inevitably generate. Insurance markets faced unprecedented challenges. War risk exclusions embedded in existing policies triggered widespread disputes about coverage, while new insurance policies became either entirely unavailable or prohibitively expensive. Marine insurance markets, in particular, faced the grim prospect of colossal claims stemming from military actions against commercial shipping, yet found themselves completely unable to assess risks or set appropriate premiums. The suspension of gold convertibility by major central banks irrevocably signaled the end of the international monetary system that had provided decades of stability and predictability. This monumental decision simultaneously ushered in profound uncertainty regarding future exchange rate relationships and international payment mechanisms. These suspensions, initially presented as temporary wartime expedients, in fact represented fundamental changes in monetary arrangements that would prove to be permanent. Emergency measures implemented by stock exchanges throughout Europe, including widespread trading suspensions and strict price limits, unequivocally demonstrated the inadequacy of normal market mechanisms for contending with the panic conditions ignited by fears of war. While these measures temporarily staved off immediate collapse, they starkly highlighted the profound vulnerability of financial markets to unpredictable political and military developments. Banking syndicates and other cooperative arrangements, originally established for typical commercial purposes, proved woefully inadequate for managing the profound crisis wrought by war preparations. This inadequacy stemmed from the simultaneous breakdown of traditional risk-sharing mechanisms, as virtually all participants confronted identical, overwhelming pressures. By early August 1914, it had become unequivocally clear that the international financial system was completely unprepared for the immense requirements of modern warfare. Traditional banking arrangements would necessarily need to be supplemented or entirely replaced by new institutional mechanisms capable of mobilizing the enormous financial resources that industrial-scale conflict would demand. The widespread financial panic that accompanied the declarations of war provided the first stark indication that the conservative banking practices and limited government financial involvement, which had characterized the pre-war system, would prove fundamentally inadequate for the challenges ahead. This critical realization thereby set the stage for the revolutionary changes in financial institutions and practices that the war would ultimately force upon the global economy. As the global financial order buckled under the weight of war declarations, the British Empire, the world's undisputed creditor, had to dismantle its own ancient traditions to survive. Britain's financial mobilization during World War I stands as the most sweeping transformation of government finance in the nation's history. It was a period during which the Treasury and the Bank of England decisively jettisoned centuries of conservative fiscal and monetary orthodoxy. They adopted revolutionary techniques that not only facilitated unprecedented government spending, but also fundamentally redefined the relationship between the state and the financial system. The immediate crisis confronting British financial authorities in August 1914 starkly revealed the complete inadequacy of traditional government finance to support modern industrial warfare. To confront the immediate existential threat to the banking system in August 1914, the British government and the Bank of England had to implement unprecedented emergency measures. To prevent a catastrophic run on the bank's gold reserves, the Treasury introduced the Currency and Banknotes Act of 1914. This authorized the issuance of massive quantities of small-denomination £1 and 10-shilling paper notes, dubbed Bradbury notes after the permanent secretary to the Treasury, to replace gold coins in internal circulation. Furthermore, the Bank of England stepped far beyond its traditional boundaries to become a market maker of last resort. Backed by a Treasury guarantee, the bank offered to purchase an enormous volume of pre-war bills of exchange that had been frozen by the conflict. By absorbing these derelict bills, eventually holding an amount equivalent to roughly 9% of the British GDP, the bank successfully restored liquidity to the City of London and saved the international discount market from complete paralysis. Britain's pre-war annual government expenditure had hovered around £200 million. However, military experts estimated that effective participation in a European war would demand annual spending of at least £500 million, with actual requirements proving far higher as the conflict intensified. Chancellor of the Exchequer. David Lloyd George's initial response to the financial crisis demonstrated both innovative thinking and an adherence to traditional principles. He endeavored to finance increased military spending through higher taxation while striving to maintain fiscal responsibility. The emergency budget of November 1914, for instance, doubled income tax rates and introduced new levies on excess profits and luxury consumption. Yet, these measures provided only a fraction of the revenues that military operations urgently required. But as the trenches deepened and the cost of conflict soared, it became evident that taxation alone could never sustain the war machine, forcing the Treasury to transform the very nature of public debt. The Treasury's groundbreaking development of comprehensive government borrowing programs represented a fundamental departure from established British financial traditions. Officials conceived and executed mass marketing campaigns designed to sell government bonds directly to ordinary citizens, rather than solely relying on traditional sales to wealthy investors and institutions. The introduction of war loans and victory bonds dramatically transformed government borrowing from an elite financial activity into a popular patriotic duty, accessible to a broader populace. Commercial banks' participation in government finance necessitated fundamental shifts in their established banking practices. Institutions that had traditionally specialized in short-term commercial lending evolved into primary dealers in long-term government securities, simultaneously developing novel techniques for managing interest rate and credit risks associated with these new roles. The Big Five clearing banks effectively became robust government bond distribution networks, even while maintaining their core traditional commercial banking operations. The inception of the National War Bonds program vividly illustrated how financial innovation could successfully mobilize resources from previously untapped sources. Marketing campaigns actively encouraged ordinary citizens to purchase government securities through convenient installment plans and small denomination bonds, rendering government finance accessible to middle-class and working-class investors for the very first time. Government control over financial markets expanded dramatically and unprecedentedly. Authorities implemented stringent controls over foreign exchange, severely restricted capital movements, and strategically directed bank lending toward essential government and civilian purposes. These controls represented unparalleled peacetime intervention in financial markets, establishing crucial precedents for government economic management that would endure long after the war's conclusion. The creation of new government institutions, including the Ministry of Munitions and various other wartime agencies, demanded financing mechanisms that extended beyond conventional budgetary processes. These agencies developed independent borrowing capabilities and financial arrangements that often circumvented normal Treasury oversight, thereby enabling rapid and agile resource mobilization. Currency management became increasingly sophisticated. The Treasury and the Bank of England pioneered techniques for effectively managing exchange rates without the traditional backing of gold, all while painstakingly maintaining international confidence in sterling through astute diplomatic and financial arrangements with allies and neutral countries. These groundbreaking techniques essentially pioneered modern foreign exchange intervention and currency management policies. The mobilization of imperial financial resources required the development of novel mechanisms for coordinating monetary and fiscal policies across the vast British Empire. Colonial governments significantly contributed to war finance, while simultaneously striving to maintain their own financial stability. The sterling area that organically emerged from these arrangements provided an influential model for post-war international monetary cooperation, demonstrating how currency arrangements could effectively serve profound political as well as economic purposes. Industrial finance arrangements that developed during the war forged new and deeper relationships between the government and private industry. Official agencies provided direct financing for crucial war production, often acquiring ownership stakes in essential industries. These arrangements notably pioneered the government-industry partnerships that would characterize British economic policy throughout the 20th century. Banking concentration accelerated notably during the war. Smaller financial institutions were progressively absorbed by larger banks that possessed the necessary capital and operational capabilities required for extensive wartime lending and government finance. This consolidation resulted in the highly concentrated banking structure that would dominate British finance for many decades, while unfortunately eliminating numerous regional and specialized institutions. International lending arrangements necessitated the development of complex new diplomatic and financial relationships with allied nations. Britain extended substantial loans to France, Russia, and other partners, while simultaneously coordinating policies to maintain exchange rate stability and ensure the effectiveness of payment systems. These arrangements established important precedents for international economic cooperation, though they also created the intricate inter-allied debt relationships that would significantly complicate post-war financial reconstruction. The expansion of financial regulation during wartime encompassed controls over securities markets, banking operations, and international capital flows. These measures represented fundamental departures from the liberal economic policies that had characterized pre-war Britain. These regulatory innovations established robust institutional capabilities for economic management that would be further expanded and refined during subsequent decades. Monetary policy innovations included advanced techniques for managing interest rates, controlling credit expansion, and coordinating policies effectively with fiscal authorities. These went far beyond the Bank of England's traditional role as merely the guardian of gold reserves and the lender of last resort. These innovations established central banking practices that would ultimately become standard tools for economic management throughout the developed world. The development of government debt markets required the creation of innovative new instruments, sophisticated marketing techniques, and specialized institutional arrangements. These were designed to mobilize savings from previously untapped sources while effectively managing the enormous scale of borrowing that wartime finance demanded. These innovations transformed government bond markets from specialized institutional preserves into mass retail markets, enabling a broader, more democratic participation in government finance. Public finance administration underwent revolutionary changes. The Treasury developed new organizational capabilities for efficiently managing unprecedented spending levels while meticulously maintaining accountability and efficiency. These administrative innovations established the institutional foundations for modern government financial management, simultaneously demonstrating how bureaucratic capabilities could be rapidly scaled during crisis conditions. By 1918, British government annual spending had soared to over £2.5 billion, more than 10 times pre-war levels, while the national debt had increased from £650 million to over £7 billion. These unprecedented fiscal changes had been accomplished through financial innovations that permanently altered British monetary and fiscal institutions, establishing techniques that would profoundly influence government economic policy throughout the world. As Great Britain exhausted its centuries of accumulated wealth, the financial center of gravity began a slow, inexorable slide across the Atlantic, landing in a nation that was still officially at peace. American financial institutions, during the Neutrality period from 1914 to 1917, experienced unprecedented growth and a dramatic surge in international influence. European war demands generated enormous opportunities for trade finance, industrial lending, and securities underwriting. This era transformed the United States from a debtor nation into the world's primary source of international capital and financial services. The initial American response to the European financial crisis demonstrated both astute opportunism and prudent caution. Wall Street firms recognized the immense potential profits available from war financing, yet maintained a traditional reluctance to become directly involved in European political conflicts. Major investment banks, including J.P. Morgan and Company, began actively exploring opportunities to finance Allied purchases of American goods, diligently avoiding direct entanglement in military operations. Commercial banking expansion reflected the enormous increase in international trade and finance business, spurred by European war demands. American banks developed new capabilities for trade finance, foreign exchange operations, and international lending, all while steadfastly maintaining their traditional domestic commercial banking services. Regional banks across the country experienced significant growth as war-related economic activity stimulated both business lending and deposit growth. Securities markets experienced remarkable development, encompassing both government and corporate bond financing that reached unprecedented scales. American corporations rapidly expanded production capacity, while European governments urgently sought financing for their military purchases. The New York Stock Exchange became increasingly vital for international capital raising, concurrently developing innovative techniques for marketing securities to both institutional and individual investors. Trade finance arrangements, which underpinned the massive increases in American exports to Europe, necessitated the development of new techniques for managing payment risks, volatile currency fluctuations, and significant transportation difficulties. These innovations were crucial for maintaining the credit facilities that enabled continuous commercial relationships despite the considerable military disruptions to normal international commerce. Industrial finance expansion mirrored the rapid growth of American manufacturing capacity. Companies aggressively expanded production to meet overwhelming European demand for military equipment, raw materials, and manufactured goods. Banks developed novel approaches to industrial lending, actively supporting the technological innovation and capacity expansion that war demand stimulated. Agricultural finance arrangements effectively supported dramatic increases in American farm production. As European agricultural output declined and demand for food products surged, rural banks and agricultural credit cooperatives expanded lending. They also developed new techniques for managing commodity price risks and seasonal financing requirements. International lending operations, which commenced during the Neutrality period, laid the foundational groundwork for America's emergence as the world's dominant creditor nation. American banks and investors provided crucial financing for allied governments and businesses, simultaneously developing the institutional capabilities that would enable continued international financial leadership after the war. While many firms profited, the magnitude of this transition was personified by one institution that became the indispensable financial bridge between the New World and the Old. J.P. Morgan & Company's pivotal role as the Allied purchasing agent in the United States demonstrated how private financial institutions could effectively serve quasi-governmental functions while generating enormous profits from war-related business. The Morgan firm's intricate coordination of Allied purchases, financing arrangements, and shipping logistics established significant precedents for investment banking involvement in government operations. Government policy toward war finance during the Neutrality period reflected inherent tensions between official neutrality and undeniable economic opportunities. The Wilson administration attempted to maintain political neutrality while permitting American businesses and banks to profit handsomely from European war demands. These policies required careful legal and diplomatic management to avoid compromising American neutrality while still enabling substantial economic benefits. Currency and exchange rate management became increasingly critical. War-related capital flows generated considerable pressures on the dollar, while European currency instability significantly affected American international business. The Federal Reserve developed sophisticated techniques for managing these pressures, concurrently supporting American financial institutions' international operations. Regional financial development throughout the United States reflected the broad distribution of war-related economic benefits. Agricultural regions experienced substantial commodity price increases, while industrial areas benefited immensely from expanded manufacturing demand. This geographic distribution of benefits inadvertently created political support for continued American involvement in war-related business. Investment banking innovation included new techniques for underwriting and marketing securities, alongside managing the inherent risks associated with war-related investments. American investment banks developed robust capabilities for large-scale securities distribution, while pioneering mass marketing techniques that would fundamentally transform American capital markets. International banking relationships that American institutions developed during the Neutrality period encompassed correspondent banking arrangements, foreign exchange operations, and lending syndications. These established permanent connections between American and European financial markets, while creating institutional capabilities for sustained international financial operations. Corporate finance arrangements that supported American industrial expansion included both debt and equity financing. These enabled companies to fully capitalize on war-related demand increases. These arrangements established important precedents for large-scale corporate finance, demonstrating how financial markets could effectively support rapid industrial development. Labor finance and social welfare arrangements that accompanied American economic expansion included industrial banking, payroll savings programs, and employee lending. These demonstrated how financial institutions could contribute to social stability while profitably benefiting from economic growth. These programs established models for employer-sponsored financial services. Technology finance and innovation funding that supported American industrial and agricultural development included lending for new equipment, research and development financing, and venture capital for new enterprises. These arrangements demonstrated how financial institutions could actively support technological progress while simultaneously generating profits from innovation. Insurance market development that accompanied American economic expansion included new products tailored for international trade, industrial operations, and personal financial security. These reflected the changing nature of American economic relationships. Insurance companies developed robust international capabilities while expanding their domestic market coverage. By early 1917, American financial institutions had been profoundly transformed by 3 years of war-related business growth, developing international capabilities and institutional sophistication that would enable effective support for American military participation while diligently maintaining the domestic financial stability that rapid economic expansion required. But while France and Britain managed to adapt their institutions to the fire of war, the Russian Empire found its foundations to be brittle, leading to a financial collapse that would reshape the map of the world. France's financial mobilization during World War I demonstrated remarkable institutional innovation and adaptive capacity. Faced with unprecedented military spending requirements and the physical destruction of significant industrial and agricultural areas, the nation's banking system developed revolutionary financing techniques that would profoundly influence government finance throughout the developed world for generations. The Bank of France's transformation from a conservative central bank to an active government financier necessitated fundamental changes in monetary policy and institutional relationships. These shifts reflected both the desperate circumstances of French military defense and the sophisticated understanding of modern finance possessed by French monetary authorities. Governor Georges Palin's policies courageously abandoned traditional gold standard constraints while diligently maintaining international confidence in the franc through astute diplomatic coordination and innovative exchange rate management. Commercial banking adaptation to wartime requirements included the development of syndicated lending arrangements for government bond distribution. These effectively mobilized savings from previously untapped sources while skillfully maintaining traditional banking relationships and services. The Crédit Lyonnais, Société Générale, and other major institutions pioneered techniques for the mass marketing of government securities, concurrently expanding their branch networks to reach rural areas and smaller cities. Government borrowing innovations included the creation of new financial instruments and marketing techniques that cleverly appealed to patriotic sentiments while providing attractive investment returns for ordinary citizens. The development of defense bonds and victory loans transformed government finance from an elite activity into a popular participatory endeavor, effectively democratizing investment while generating enormous amounts of capital for military operations. Regional banking coordination throughout France required maintaining essential financial services in areas directly threatened by military action, while strategically redirecting resources toward government finance and crucial civilian activities. Provincial banks demonstrated remarkable adaptability and patriotic cooperation, diligently maintaining local economic relationships that supported community stability during acute crisis conditions. International financial relationships that France maintained during the war included complex arrangements with Britain, the United States, and other allies. These provided essential foreign exchange and critical import financing, while also creating intricate inter-allied debt relationships that would significantly influence post-war international financial reconstruction. These arrangements powerfully demonstrated how financial cooperation could effectively bolster military alliance relationships. Industrial finance arrangements that supported the rapid conversion of civilian production to military purposes required the forging of new relationships between banks and manufacturing enterprises. These innovative partnerships simultaneously enabled continued technological development and crucial production efficiency improvements. But the revolution was not limited to the grand halls of Paris. It extended to the very factories and farms struggling under the weight of occupation. French banks rapidly honed their expertise in industrial project finance, extending crucial support to the myriad small and medium enterprises that formed the backbone of war production. Concurrently, innovative agricultural finance arrangements were devised to sustain vital food production, even amidst widespread military mobilization and territorial occupation. This involved novel lending techniques and robust government support programs, which proved instrumental in keeping rural communities viable and ensuring essential food supplies reached urban centers. Rural credit cooperatives, in particular, significantly broadened their operations and adapted flexibly to the challenging wartime environment. Maintaining the stability of the French franc, despite immense government borrowing and a surge in monetary expansion, demanded highly sophisticated international coordination and astute domestic financial management. These measures were critical for preserving public confidence while simultaneously allowing for virtually unlimited government spending. Notably, these policies laid the groundwork for modern techniques of managing exchange rates without the traditional backing of gold. The war also catalyzed a significant shift towards bank-based finance through the creation of new semi-public banks, banques parapubliques. Rather than relying on covert operations, the French state transparently established specialized, state-controlled but publicly traded joint stock institutions, such as the Crédit National, created to manage war damage indemnities, and the Banque Nationale Française du Commerce Extérieur, BNFCE. These institutions were designed to handle the massive financial burdens of post-war reconstruction and international trade that exceeded the capacity of conventional commercial banks, thereby establishing important precedents for state-directed investment and modern public-private financial partnerships. Social welfare finance played a pivotal role in sustaining public support for the prolonged military effort. Programs like family allowances, pension schemes, and employment assistance clearly demonstrated how financial mechanisms could effectively serve broader social policy objectives while simultaneously upholding economic stability. These initiatives, in essence, laid the foundational stones for the comprehensive welfare state that would define post-war France. The development of the securities market became indispensable for supporting the massive scale of government borrowing. This necessitated the creation of entirely new trading mechanisms, clearing systems, and investor services capable of managing unprecedented transaction volumes, all while ensuring market stability and investor confidence. The Paris Bourse Stock Exchange dynamically adapted its operations, pioneering innovative techniques for the distribution and trading of government bonds. Adaptations within the insurance market addressed new war-related risks and evolving social needs. This led to the introduction of novel products catering to military families, industrial operations, and international trade, showcasing how insurance could adeptly serve both private interests and public policy goals. French insurance companies not only expanded their reach but also cultivated specialized expertise in navigating these unparalleled risks. Technology finance arrangements were crucial for preserving French industrial competitiveness, despite severe resource constraints and the overriding military priorities. Government-backed research and development programs ensured that French enterprises remained at the cutting edge of industrial innovation, establishing vital models for state support of technological advancement. To maintain French commercial relationships amidst global military conflict, international trade finance arrangements evolved to include alternative payment systems and credit facilities. These innovations facilitated continued commerce with neutral countries and enabled the financing of essential imports. French banks, operating under extreme conditions, thus pioneered groundbreaking techniques in trade finance. Labor finance programs were instrumental in maintaining worker productivity and social stability. These included initiatives like payroll savings programs, housing finance, and consumption subsidies, which illustrated how financial mechanisms could bolster comprehensive social mobilization while still providing economic incentives for sustained work and production. Corporate finance innovations helped businesses adapt to the unique demands of wartime. Government loan guarantees, directed investment programs, and targeted tax incentives were put in place. These measures sustained private enterprise capabilities while ensuring that business activities aligned with national objectives, establishing precedents for mixed economy structures. Resource mobilization techniques were refined to effectively convert private wealth into public resources. This involved innovations in taxation, forced savings programs, and asset requisition procedures. These approaches carefully balanced the maintenance of property rights with the critical need to ensure national resources were readily available for military purposes, influencing tax policy and government finance across the developed world. The expansion of banking regulation provided comprehensive government oversight of financial operations. This included controls over credit allocation, foreign exchange transactions, and securities trading, clearly demonstrating how emergency conditions could justify extensive government involvement in previously private financial relationships. By 1918, French financial institutions had collectively displayed remarkable innovation and adaptability, laying a robust foundation for military survival and ultimate victory. The sophisticated techniques developed during the war set crucial precedents for government economic management, profoundly shaping French economic policy throughout the 20th century, and contributing innovations that would become standard practices in modern government finance. But while France and Britain forged innovation through fire, the Russian Empire's foundations proved brittle, turning its wartime financial burden into the catalyst for a total systemic collapse. The catastrophic breakdown of the Russian financial system during World War I stands as the most dramatic illustration of how even established banking institutions could completely crumble under the immense pressures of modern warfare. This collapse spawned profound economic chaos, directly fueling the revolutionary upheaval and ultimately leading to the demise of the Tsarist political system. Initially, the Russian state bank appeared to possess a stronger position than many of its European counterparts, boasting substantial gold reserves and a history of conservative monetary policies that had fostered currency stability and economic growth in the pre-war era. However, the sheer scale of resources demanded for Russian military mobilization quickly overwhelmed the financial system's capacity, simultaneously exposing deep-seated structural weaknesses within Russia's economic and political institutions. Government borrowing requirements during the war period surged to over 15 billion rubles, a figure more than triple Russia's entire pre-war national income. Such unprecedented financial demands proved impossible for existing institutional arrangements to support through conventional means. The Russian government's desperate attempts to meet these needs through a combination of foreign borrowing, domestic bond sales, and monetary expansion all proved utterly inadequate, instead creating cumulative pressures that irrevocably destroyed confidence in Russian financial institutions. Commercial banking operations across the vast Russian Empire suffered severe disruption. Military mobilization coupled with pervasive economic chaos triggered massive deposit withdrawals. As traditional lending relationships disintegrated, regional banks, which had previously played a vital role in agricultural and commercial development, found themselves utterly unable to adapt to wartime conditions or maintain even basic financial services for their communities. Currency creation by the state bank escalated to unprecedented levels, as government financing requirements eclipsed all other funding sources combined. The bank's note circulation dramatically increased from 1.6 billion rubles in 1914 to over 9 billion rubles by 1917. This rampant expansion ignited runaway inflationary pressures, systematically eroding the purchasing power stability that had been absolutely essential for economic planning and commercial relationships. Russia's international financial relationships, painstakingly cultivated with French and British investors, became an additional source of immense pressure. Foreign creditors began demanding payment, while securing new international loans grew increasingly difficult. The intricate web of international obligations that had underpinned Russian development became impossible to service, severely constraining the government's diplomatic and military options. Industrial finance arrangements, which had fueled rapid Russian development before the war, proved woefully inadequate for wartime mobilization. Banks simply lacked the institutional capabilities and capital resources needed to support the large-scale conversion of civilian production to military purposes, all while struggling to maintain essential consumer goods production. Similarly, agricultural finance systems, once responsible for Russia's emergence as a major grain exporter, experienced a complete breakdown. Military mobilization siphoned off rural labor, while transportation and marketing systems were thrown into disarray. Rural credit cooperatives and agricultural banks, like their commercial counterparts, were unable to adapt and sustain food production support. Throughout the vast Russian Empire, regional banking disparities created widely divergent financial conditions, rendering any coordinated national financial policy impossible to implement effectively. While some regions endured a complete banking collapse, others managed to maintain limited services. However, the overall coordination essential for effective national financial planning simply ceased to exist. Government economic controls, implemented by authorities in a bid to address the burgeoning financial crisis, included price controls, currency restrictions, and resource allocation policies. Yet these measures largely interfered with market mechanisms without ever addressing the underlying problems of excessive government spending and rampant monetary expansion. Instead, these controls only created further economic distortions and severely undermined confidence in government economic management. Inflation accelerated to crisis proportions by 1916, utterly destroying the economic planning and stable pricing relationships that had previously supported Russian commercial and industrial development. The dangerous combination of unlimited currency creation and severe wartime resource constraints led to price increases that rendered normal economic relationships impossible to sustain, further eroding public confidence in the government's financial competence. Social welfare finance, already limited in pre-war Russia, proved completely inadequate in addressing the profound hardships inflicted upon ordinary citizens by military mobilization and economic disruption. The glaring absence of effective social support systems fostered widespread popular discontent, directly contributing to the revolutionary conditions that swept the nation. This crisis underscored the critical importance of financial mechanisms for maintaining social stability. International trade finance, which had facilitated Russian exports and imports, experienced a complete breakdown. Currency instability and pervasive political uncertainty made normal commercial relationships unsustainable. The disruption of international commerce effectively cut off vital sources of foreign exchange that had been essential for Russia's economic development. However, the collapse was not just in the ledger books. It was a failure of the very human and institutional capital required to keep a nation's economy breathing. Banking personnel and the institutional capacity within the financial sector proved profoundly inadequate for managing the crisis conditions spawned by wartime finance. Traditional banking skills and experience offered little guidance for addressing the unprecedented challenges of maintaining basic financial services under such extremely difficult circumstances. As the traditional financial elite stood paralyzed by the scale of the crisis, the vacuum of authority was filled by radical ideologies promising a total reconstruction of the economic order. Revolutionary financial policies, initially implemented by the Provisional Government in 1917, aimed to tackle the inherited problems through institutional reforms and new policies. However, these efforts ultimately proved insufficient to address the fundamental economic imbalances. Competing political forces prevented consistent policy implementation, paving the way for the Bolshevik financial policies that followed the October Revolution. These included the repudiation of foreign debts, the nationalization of banking institutions, and the abolition of private property rights, effectively completing the destruction of traditional Russian financial relationships and ushering in entirely new economic arrangements based on socialist principles. The massive war debt obligations Russia had accumulated through foreign borrowing created severe international political and economic complications, significantly influencing post-war diplomatic relationships and establishing precedents for debt repudiation during periods of revolutionary political change. The Russian default, in particular, had repercussions that affected international lending relationships for decades. Industrial banking relationships, which had been instrumental in Russia's pre-war economic development, were obliterated through nationalization and revolutionary reorganization. This eliminated the financial mechanisms that had powered rapid growth and replaced them with new institutional arrangements founded on central planning rather than market dynamics. The accelerating currency collapse during 1917 and 1918 effectively rendered the ruble useless as an effective medium of exchange. This forced Russian communities to improvise and develop alternative payment systems, including widespread barter arrangements and local currencies, reflecting the complete breakdown of national financial institutions. Economic reconstruction efforts, initiated under Bolshevik leadership, necessitated the development of entirely new financial institutions and monetary arrangements. These bore no resemblance to traditional banking and were instead designed to serve the specific requirements of socialist economic planning and political control. Ultimately, the Russian financial collapse provided a stark demonstration of how overwhelming military and political pressures could utterly destroy sophisticated financial institutions. It also vividly illustrated how such an economic breakdown could directly contribute to revolutionary political change. The Russian experience served as a potent warning about financial sustainability, influencing policy throughout the developed world, and establishing enduring precedents for both debt repudiation and comprehensive financial system reconstruction that would sadly be repeated during subsequent political upheavals. While the financial collapse in the East signaled the end of an old imperial order, across the Atlantic, a new power was preparing to unleash a financial mobilization on a scale the world had never seen. America's entry into World War I in April 1917 marked the most dramatic expansion of government finance in the nation's history. Treasury officials and Federal Reserve authorities swiftly developed revolutionary techniques for mobilizing domestic resources, fundamentally transforming the United States from a creditor nation into the undisputed arsenal of democracy through unparalleled financial innovation and institutional expansion. Treasury Secretary William McAdoo's comprehensive strategy for war finance ingeniously combined traditional taxation methods with groundbreaking borrowing techniques. These methods effectively mobilized American savings through sophisticated mass marketing campaigns that successfully transformed government bond ownership from an exclusive preserve of the elite into a widely embraced patriotic duty. McAdoo's Liberty Bond program thus became the foundational bedrock for modern government securities markets, powerfully demonstrating how strategic financial appeals could simultaneously achieve crucial economic and political objectives. Yet beneath the patriotic fervor of the marketing campaigns lay a sophisticated mechanical engine of financial engineering that provided the necessary grease for the gears of war. The success of the Liberty Bond program relied not only on patriotic mass marketing, but also on pioneering financial engineering. To democratize war financing, the government introduced war thrift stamps priced at just 25 cents. Citizens could accumulate these on cards and eventually exchange them for a $50 Liberty Bond, making government securities affordable even to the poorest Americans. Furthermore, the Treasury actively encouraged a borrow and buy strategy, urging citizens to take bank loans to purchase bonds. To facilitate this massive credit expansion, the Federal Reserve offered member banks preferential discount rates on loans collateralized by Liberty bonds. Crucially, to extend this program to institutions outside the Federal Reserve system, the Fed utilized a novel monetary tool: repurchase agreements, repos, ensuring that even non-member banks had the necessary liquidity to absorb government debt. The Federal Reserve System underwent significant wartime expansion, incorporating fundamental changes in its monetary policy and institutional capabilities. It shed traditional central banking constraints in favor of an unprecedented expansion of credit, specifically designed to bolster government borrowing and facilitate industrial mobilization. The Fed's transformation from a conservative guardian of currency to an active economic manager set vital precedents that would continue to influence American monetary policy throughout the entire 20th century. Commercial banking operations adapted dynamically to the exigencies of wartime finance. This involved the rapid development of syndicate arrangements for the widespread distribution of government bonds, alongside an expansion of industrial lending, all while skillfully maintaining traditional commercial banking services for ongoing civilian economic activities. American banks showcased remarkable institutional flexibility, swiftly developing new capacities to manage unprecedented transaction volumes and complex credit relationships. The development of the securities market proved critical in supporting the massive scale of government borrowing. This entailed the creation of innovative trading mechanisms, efficient clearing systems, and broad distribution networks, all capable of handling bond offerings reaching billions of dollars while rigorously maintaining market stability and investor confidence. The New York Stock Exchange significantly expanded its operations, pioneering new techniques specifically for government securities trading. Industrial finance arrangements were crucial for supporting the rapid expansion of military production. This necessitated the forging of new relationships between banks and manufacturing enterprises, fostering technological innovation and significant improvements in production efficiency. These advancements collectively propelled American industry to become the world's most capable military supplier. Banks, for their part, cultivated deep expertise in project finance, offering robust support to the small and medium enterprises that were vital contributors to war production. Regional financial mobilization across the sprawling United States vividly demonstrated how a decentralized banking system could effectively coordinate national objectives while simultaneously preserving essential local economic relationships and services. Rural banks, urban commercial banks, and specialized financial institutions alike all contributed significantly to war finance, deftly adapting their operations to serve both overarching national and specific community requirements. International lending operations, which provided critical financing for allied governments, unequivocally established the United States as the world's dominant creditor. These extensive financial relationships would go on to profoundly influence international politics and economics for decades to come. American loans to Britain, France, and other allies eventually surpassed $10 billion, solidifying institutional capabilities for sustained international financial leadership. Effective government financial administration was essential for managing unprecedented spending levels. This demanded the development of entirely new institutional capabilities and organizational structures designed to maintain accountability and efficiency, even while handling transaction volumes that far exceeded all previous government operations. The Treasury Department substantially expanded its staff and operations, pioneering modern techniques in government financial management. Public finance education campaigns, strategically launched alongside Liberty bond sales, included comprehensive programs aimed at educating American citizens about government finance, fundamental investment principles, and their patriotic duty. These initiatives fundamentally transformed public understanding of financial relationships and engendered lasting changes in American investment behavior and economic attitudes. Corporate finance arrangements facilitated business adaptation to wartime conditions. This involved a suite of government contracts, loan guarantees, and tax incentives, which successfully maintained the capabilities of private enterprise while ensuring that business activities directly supported national objectives. These arrangements established important precedents for government-business cooperation that would influence American economic policy for decades. Agricultural finance underwent significant expansion to support increased food production for both domestic and allied requirements. This included new credit programs, effective price support mechanisms, and sophisticated marketing arrangements. These policies powerfully demonstrated how financial strategies could simultaneously serve vital economic and national security objectives, all while maintaining agricultural productivity and rural economic stability. Labor finance programs were implemented to maintain worker productivity and social stability during the period of military mobilization. These encompassed payroll savings programs, housing finance initiatives, and various employee benefits. Such measures highlighted how financial mechanisms could effectively support comprehensive social mobilization while simultaneously preserving economic incentives for continued work and production. Financing for technology development proved crucial in supporting military innovation and production improvement. This included government research contracts, strategic patent policies, and industrial development programs, all designed to maintain American technological leadership while addressing immediate military requirements. These arrangements laid robust foundations for sustained government support of technological development. The expansion of banking regulation provided comprehensive government oversight of wartime financial operations. This involved controls over credit allocation, foreign exchange transactions, and securities trading, demonstrating how emergency conditions could justify extensive government involvement in previously private financial relationships while simultaneously maintaining institutional efficiency. State and local government finance arrangements played a supportive role in wartime mobilization, coordinating effectively with federal programs while diligently maintaining essential public services and crucial infrastructure development. These arrangements exemplified how different levels of government could cooperatively engage in financial mobilization while carefully preserving existing federal institutional relationships. The insurance market also saw significant expansion, adapting to address new wartime risks and evolving social needs. This led to the introduction of novel products tailored for military families, industrial operations, and international activities, demonstrating how insurance could serve both private and public policy objectives while maintaining institutional profitability and stability. International trade finance arrangements were vital for supporting allied purchasing and facilitating American export expansion. This required the development of innovative techniques for managing payment risks, mitigating currency fluctuations, and overcoming transportation difficulties, all while striving to maintain commercial relationships despite widespread military disruptions to normal international commerce. Resource mobilization techniques were ingeniously employed to convert private savings into public resources. These included innovative taxation, widespread voluntary savings programs, and public-private partnerships that successfully balanced the maintenance of property rights and economic incentives with the paramount need to ensure national resources were readily available for military purposes. These pioneering techniques profoundly influenced government finance policy across the developed world. By late 1918, American financial institutions had unequivocally demonstrated remarkable capabilities for economic mobilization. They not only established critical institutional precedents but also pioneered technical innovations that would profoundly influence government finance, monetary policy, and international economic relationships throughout the remainder of the 20th century, definitively confirming America's emergence as the world's dominant financial power. But the true genius of the American mobilization lay not just in the vaults of the Federal Reserve, but in the pockets of its citizens, as the government learned to turn individual patriotism into a vast, untapped pool of capital. The innovative development of mass government bond marketing during World War I stands as one of the most pivotal advancements in the history of public finance. Authorities in every major belligerent nation discovered ingenious ways to mobilize the savings of ordinary citizens for government purposes, simultaneously catalyzing lasting changes in investment behavior and fundamentally reshaping the relationship between individuals and government financial operations. The British National War Bonds program pioneered sophisticated techniques for selling government securities to working-class and middle-class investors, many of whom had never previously owned government bonds. This was achieved through the introduction of installment payment plans, small denominations, and efficient workplace distribution systems, which collectively made government securities readily accessible to average income earners. These groundbreaking innovations effectively transformed government borrowing from an exclusive, elite financial activity into a widespread and popular act of patriotic participation. American Liberty Bonds emerged as arguably the most successful mass government security distribution program in history. Treasury Secretary William McAdoo's brilliantly conceived marketing campaigns skillfully fused potent patriotic appeals with highly sophisticated sales techniques. This colossal effort mobilized over 20 million individual purchases, ultimately raising more than $17 billion through 4 separate bond issues between 1917 and 1919. In Germany, the war loan campaign starkly demonstrated how authoritarian governments could achieve remarkable success in mobilizing domestic savings. This was accomplished through comprehensive propaganda campaigns and intense social pressure, which effectively framed government bond purchases as a crucial measure of patriotic duty. Crucially, these bonds also offered attractive investment returns that competed effectively with private sector alternatives. French defense bond marketing efforts included innovative techniques specifically designed to reach rural populations and small savers. These individuals had traditionally kept their wealth in bank deposits or, notably, engaged in gold hoarding. Using extensive networks of local banks, post offices, and community organizations, government securities were made available throughout the country, coupled with educational initiatives to enlighten citizens about basic investment principles. The array of marketing techniques developed for government bond sales represented a true revolution in public relations. These included sophisticated advertising campaigns, leveraging celebrity endorsements, organizing informative workplace presentations, and engaging in direct door-to-door sales efforts. Such methods effectively pioneered modern mass marketing, demonstrating how powerful emotional appeals could be strategically combined with tangible financial incentives to achieve unprecedented sales volumes and broad geographic distribution. The distribution systems essential for enabling mass government bond sales necessitated the development of entirely new institutional arrangements. These systems had to be capable of efficiently handling millions of individual transactions, while rigorously maintaining record-keeping accuracy and providing comprehensive customer services, features that had never before been required for traditional government borrowing, which typically involved only wealthy investors and large institutions. Installment payment plans were a key financial innovation, making government bonds accessible to ordinary income earners. These plans allowed individuals with limited immediate cash reserves to acquire securities through convenient payroll deductions and flexible monthly payment arrangements. In doing so, they established crucial precedents for consumer finance that would profoundly influence American financial markets throughout the 20th century. Workplace distribution programs facilitated government bond sales through strategic employer partnerships. These programs often included payroll deduction plans, organized workplace presentations, and even peer pressure campaigns, which collectively achieved remarkable participation rates. They compellingly demonstrated how existing employment relationships could be harnessed to serve both government finance objectives and broader patriotic mobilization efforts. Educational campaigns, intrinsically linked to government bond marketing, comprised comprehensive programs designed to instruct citizens about investment principles, government finance, and fundamental economic relationships. These initiatives significantly transformed public understanding of financial markets and instilled lasting changes in American investment behavior and attitudes toward government securities. Celebrity endorsements and advanced propaganda techniques became integral to supporting government bond marketing. The enthusiastic participation of movie stars, athletes, and other prominent public figures in sales campaigns powerfully demonstrated how popular culture could be effectively leveraged to serve government finance objectives. This also pioneered techniques for celebrity marketing that would ultimately become standard practices in American advertising. However, behind the glittering surface of celebrity endorsements and patriotic posters, a massive administrative engine had to be built to manage the unprecedented flood of retail transactions. Community organization and social pressure techniques were also strategically deployed to bolster government bond sales. Neighborhood committees, social group competitions, and public recognition programs were established, transforming bond purchases into a clear measure of community participation and patriotic duty. This effectively showcased how social relationships could be mobilized to serve crucial government policy objectives. Pricing and yield strategies were carefully designed to make government bonds genuinely attractive to ordinary investors. This included offering competitive interest rates, significant tax advantages, and flexible payment terms that often provided superior returns compared to traditional bank deposits and other common savings vehicles, all while maintaining affordability for middle-class and working-class purchasers. Efficient record-keeping and administrative systems were paramount for enabling mass government bond distribution. This necessitated the development of new organizational capabilities capable of managing millions of individual accounts, alongside providing essential customer services such as payment processing, redemption procedures, and investor communications, all of which were critical for maintaining public confidence and satisfaction. International coordination of government bond marketing involved a vital sharing of techniques and strategies among allied governments. Programs were adapted to suit different national cultures and political systems, demonstrating how financial innovations could be successfully transferred across national boundaries while simultaneously serving common strategic objectives. The long-term consequences of widespread mass government bond ownership were profound. It fostered the creation of significant constituencies for government financial management and established enduring precedents for public participation in government finance. These developments would continue to influence tax policy, monetary policy, and the political relationships between citizens and government throughout the remainder of the 20th century. The resulting financial market development, stemming directly from these government bond marketing innovations, was transformative. These innovations fostered the expansion of securities trading, investment services, and financial education, fundamentally transforming American capital markets. They also laid the groundwork for robust institutional frameworks that would continue to fuel market growth and sophistication for decades. Mass ownership of government bonds brought about significant social and cultural shifts. Attitudes toward investment, government finance, and personal financial responsibility evolved, mirroring broader societal changes and showcasing how financial engagement could support both social policy goals and national unity. The varied success of government bond marketing across different countries highlighted how financial programs needed to be meticulously tailored to local economic conditions, cultural nuances, and institutional strengths. This demonstrated the crucial balance between achieving national objectives and garnering localized political support. Corporate involvement in bond marketing was extensive, encompassing employer-sponsored programs, leadership from the business community, and widespread corporate advertising. This participation underscored the capacity of private enterprise to contribute to public objectives while seamlessly maintaining its business relationships and commercial activities during wartime mobilization. Furthermore, the marketing strategies pioneered new demographic techniques by crafting specific appeals to women, various ethnic groups, and distinct occupational categories. This approach effectively demonstrated how financial initiatives could resonate with the diverse interests and motivations of different social segments. Economically, successful government bond marketing efforts unlocked previously untapped sources of savings. This, in turn, forged new and enduring relationships between government finance and private savings, profoundly influencing fiscal and monetary policies throughout the modern era. characterized by expanded government economic responsibilities. The sustained ownership of government bonds in the post-war period created a powerful, lasting constituency for government securities markets. It also cemented institutional capabilities and public attitudes that would facilitate continued government borrowing for both economic management and a wide array of social programs throughout the remainder of the 20th century. The mass mobilization of finance had successfully channeled the world's savings into the war effort. But as the costs of industrial slaughter outpaced even the most patriotic contributions, a darker economic force began to rise. The unbridled financial demands of total war unleashed an inflationary crisis, causing widespread economic disruption across all belligerent nations. Governments, in their urgent quest for unprecedented resource mobilization, largely abandoned traditional monetary discipline. While this enabled massive wartime spending, it simultaneously eroded the price stability and economic predictability that had underpinned pre-war commercial relationships and social order. This massive monetary expansion, intrinsically linked to vast government borrowing, led to rapid currency depreciation and escalating price increases throughout the war. Authorities consistently prioritized sustained military spending over monetary stability, a decision that powerfully illustrated how compelling political pressures could override fundamental economic constraints, with long-term consequences for post-war economic development. In an attempt to manage this spiraling inflation, governments implemented extensive price control measures, imposing comprehensive regulations across essential commodities, labor markets, and commercial relationships. However, these administrative interventions ultimately failed to resolve the fundamental imbalance between unlimited government expenditure and finite real resources, leading instead to the proliferation of black markets and significant economic distortions. International currency relationships, previously stabilized by the gold standard, suffered severe disruption. Automatic adjustment mechanisms were superseded by competitive devaluations and strict exchange controls, introducing pervasive uncertainty and risk. This complicated international trade and investment significantly, while also fostering a climate of post-war economic nationalism. The social ramifications of inflation were profound, including the erosion of fixed incomes, severe disruption to savings and retirement planning, and a significant redistribution of wealth from creditors to debtors. These shifts generated considerable political tensions and social instability, revealing how monetary policies could inadvertently act as mechanisms for involuntary wealth transfer among different social strata. While every nation felt the sting of rising prices, the collapse of monetary order reached its most terrifying conclusion in the heart of Central Europe. The German hyperinflation of the early 1920s stands as the most extreme illustration of how unchecked government borrowing and monetary expansion could utterly obliterate currency stability and economic relationships. The severity of Germany's post-war economic collapse was rooted in fatal structural vulnerabilities unique to its financial mobilization. Unlike Britain and France, which possessed deep domestic money markets and secured over $2 billion in loans from Wall Street to absorb their debt and finance trade deficits, Germany's money market was comparatively underdeveloped and isolated from global capital. Consequently, the Reichsbank was forced to directly monetize massive amounts of short-term government debt. Furthermore, to circumvent the legal constraints of the gold standard, German authorities heavily relied on loan bureaus, Darlehenskassen, to issue alternative notes, which the central bank dangerously counted as primary reserves alongside actual gold. This precarious financial engineering created a fatal illusion of stability, resulting in a suppressed inflation during the war years. However, contrary to popular belief, the hyperinflation of 1923 was not an inevitable direct result of wartime finance. While World War I created the structural vulnerabilities, the actual hyperinflation was triggered by deliberate post-war policies. The fragile Weimar Republic resorted to massive money printing to manage crushing Allied reparations and to subsidize the passive resistance during the French occupation of the Ruhr, turning the wartime inflationary potential into a catastrophic reality. This catastrophic event plunged the nation into social chaos and profound political instability, directly contributing to the emergence of extremist political movements and the eventual collapse of democratic institutions. American inflation, accelerating significantly in 1917 and 1918, was driven by both extensive domestic war spending and substantial international capital flows, as European allies financed purchases of American goods with borrowed dollars. This surge in demand created intense price pressures, which Federal Reserve authorities endeavored to control through pioneering interest rate policies and credit controls, thereby establishing crucial precedents for modern monetary management. Meanwhile, France experienced significant monetary expansion, but inflation was successfully kept in check during the war years through strict state price controls and a clever circuit policy that funneled excess liquidity back into government short-term bonds. It was not until the post-war era that this suppressed inflation burst into a severe crisis. Such economic hardships inevitably exacerbated post-war political and social tensions. Inflation triggered widespread disruptions within labor markets, manifesting as insistent demands for wage increases to match rising prices. Simultaneously, employers grappled with escalating cost pressures that imperiled profitability and production capacity. These conflicting forces fueled industrial relations conflicts, necessitating government intervention and mediation, and in turn, establishing precedents for wage indexation and broader labor market regulation. The agricultural sector experienced significant price volatility amidst the general inflation, marked by dramatic increases in food costs that caused considerable social hardship for many. Paradoxically, this period also delivered windfall profits to farmers capable of capitalizing on the surge in demand, vividly illustrating how inflation could create distinct winners and losers, fundamentally disrupting traditional economic relationships and social structures. International trade faced substantial complications stemming from currency instability and inflation. Businesses struggled with accurately pricing long-term contracts, effectively managing exchange rate risks, and maintaining stable commercial relationships as monetary values fluctuated wildly. This environment compelled companies to innovate new techniques for international commerce, even as it erected significant barriers to trade expansion. Governments attempted to manage inflationary pressures through various fiscal measures, including efforts to increase taxation, reduce non-military spending, and coordinate monetary policy with fiscal objectives. However, these steps proved insufficient to tackle the underlying fundamental imbalances, largely because political pressures often precluded the implementation of policies that, while potentially curbing inflation, might have compromised military effectiveness. Central banks, in turn, responded by attempting to manage money supply growth, coordinate international monetary policies, and bolster confidence in domestic currencies. Yet, these efforts were severely constrained by the immense government borrowing requirements, rendering traditional monetary discipline impractical. This period thus set a precedent for central banks operating in a subordinate role to fiscal authorities. Businesses adapted to the inflationary environment by developing innovative accounting methods, flexible pricing strategies, and advanced inventory management techniques. These adaptations were crucial for companies to maintain operations while safeguarding against currency depreciation and escalating costs, thereby pioneering business practices that would become standard during subsequent inflationary periods. Consumer behavior also underwent significant changes. People adjusted their saving and spending patterns, learning to protect their wealth against currency depreciation and adapting consumption habits to rapidly changing relative prices. These social and cultural shifts had a lasting impact on economic relationships throughout the post-war period. International coordination efforts aimed at tackling inflation through cooperative policies included allied financial coordination and currency stabilization arrangements. While these initiatives established important precedents for future international economic cooperation that would inform post-war monetary reconstruction, they ultimately proved inadequate to address the fundamental underlying problems. Regional variations in the impact of inflation were pronounced, reflecting diverse economic conditions, governmental policies, and social structures across different nations. This starkly demonstrated how national policies could have disparate consequences in various geographic areas and for different social groups, thereby generating political pressures for tailored policy responses. Amidst this crisis, significant strides were made in measurement and statistical development, enhancing the understanding of inflation. This included the creation of price indices, comprehensive cost of living studies, and more rigorous economic analysis. all of which provided policymakers with superior information. These advancements also established crucial institutional capabilities for economic monitoring, paving the way for more sophisticated economic management in subsequent periods. The long-term consequences of wartime inflation included a fundamental shift in expectations regarding price stability and altered attitudes toward government economic management. Furthermore, it established institutional precedents for monetary expansion that would shape economic policy throughout the remainder of the 20th century, simultaneously fostering political constituencies advocating for continued government economic intervention. The post-war deflation that subsequently followed the inflationary expansion introduced further economic disruption. Authorities attempted to restore price stability and currency credibility through contractionary policies, which, while necessary, imposed severe economic hardships. This period vividly demonstrated the inherent difficulties in reversing inflationary policies once they had become deeply entrenched in economic relationships and political expectations. The dust of the inflationary collapse eventually settled, but it revealed a world whose financial foundations had been permanently altered. The task was no longer to rebuild what was lost, but to reconcile with a new, irreversible economic reality. The financial aftermath of World War I presented unprecedented challenges for international economic reconstruction. Governments grappled with restoring monetary stability and fiscal responsibility, while simultaneously managing colossal debt burdens, persistent currency instability, and the intricate web of inter-allied financial obligations spawned by wartime finance. A particularly thorny issue was the German reparations. These obligations, imposed by the Treaty of Versailles, introduced significant international financial complications. Germany, the defeated power, was compelled to make payments that far exceeded its economic capacity, all while attempting to maintain domestic political stability. This inherent tension between international obligations and internal economic requirements became a major contributor to widespread political instability throughout the 1920s and 1930s. Beyond the immediate struggle of reconciling international debts, the war had fundamentally altered the DNA of banking itself, forcing a synthesis between Old World discipline and New World responsibility. Post-war currency stabilization efforts sought to re-establish gold standard relationships and exchange rate stability. However, these endeavors proved challenging given the massive shifts in national economic strengths and the persistent political demand for the expansionary policies that war finance had instilled across the belligerent nations. Concurrently, extensive debt reconstruction and refinancing became imperative, as involving comprehensive reorganization of government obligations and painstaking negotiations between creditors and debtors to restore investor confidence in public finance and monetary management. These efforts set crucial precedents for international debt management and restructuring. The reconstruction of banking systems focused on restoring conservative lending practices and monetary discipline, while simultaneously preserving the expanded capabilities and public responsibilities that wartime finance had necessitated. This required a delicate balance between financial stability and the ongoing involvement of government in the economy. International monetary cooperation emerged, aimed at coordinating currency policies and restoring global financial stability through new institutional arrangements that recognized changed conditions while respecting national sovereignty over domestic economic policy. This laid the groundwork for future international monetary frameworks. Managing inflation and stabilizing currencies after wartime expansion mandated the development of novel techniques for controlling price levels and currency values, all while sustaining economic activity and employment. This period underscored how monetary policy had evolved into a far more complex and politically sensitive undertaking than the operations required under the traditional gold standard. Fiscal policy reconstruction involved concerted efforts to re-establish balanced budgets and reduce burgeoning government debt burdens. This was complicated by the need to maintain the expanded public services and social welfare programs that war mobilization had introduced, creating enduring tensions between fiscal responsibility and political calls for continued government economic intervention. Financial market development built directly upon wartime innovations, witnessing the sustained expansion of government securities markets, enhanced corporate finance capabilities, and increased mass investment participation. These advancements adapted to peacetime economic conditions and regulatory requirements, addressing issues identified during wartime financial operations. International trade finance also underwent reconstruction, restoring commercial relationships shattered by war through the creation of new payment systems, currency arrangements, and credit facilities. These innovations supported expanded international commerce while navigating the inherent risks and uncertainties of ongoing political tensions and economic instability. Regional economic reconstruction tackled war damage and industrial conversion. This included financial provisions for rebuilding destroyed infrastructure and repurposing military production capacity for civilian use. Such efforts demanded close coordination between public and private finance, crucial for maintaining employment and economic stability during these complex transition periods. Social welfare finance addressed a spectrum of war-related social needs, establishing pioneering programs such as pensions for veterans and war widows, unemployment assistance for demobilized military personnel, and health care for war-related injuries and disabilities. These initiatives set precedents for the comprehensive social welfare systems that would subsequently expand throughout the 20th century. Corporate finance reconstruction responded to wartime industrial changes by reorganizing enterprises that had expanded rapidly during war production, helping them adapt to peacetime markets and renewed competition. This necessitated fresh approaches to business finance and meticulous management of the transition from government contracts to private market relationships. Labor market finance addressed the challenges of demobilization and industrial conversion through programs focused on veteran employment, worker retraining, and fostering stable industrial relations. These measures were vital for maintaining social stability while accommodating changed economic conditions and evolving relationships among government, business, labor organizations. Technology transfer and innovation finance capitalized on wartime technological advancements by facilitating the conversion of military innovations to civilian applications. It also ensured continued investment in research and development capabilities, essential for long-term economic competitiveness and industrial development. Insurance market reconstruction addressed war-related shifts in risk management by developing new products and institutional arrangements. These innovations not only served expanded social welfare functions, but also preserved private sector efficiency and innovation in risk assessment and management. Educational and cultural finance supported broader post-war social reconstruction through programs dedicated to veteran education, adult retraining, and cultural development. These initiatives powerfully demonstrated how financial mechanisms could serve expansive social objectives while simultaneously fostering individual opportunity and social mobility. Agricultural finance reconstruction addressed wartime production changes through programs designed to convert expanded agricultural capacity to peacetime markets, while maintaining rural economic stability and food security, requiring intricate coordination between price support mechanisms and international trade policy. International investment and development finance provided crucial arrangements for mobilizing capital for European reconstruction. These efforts prioritized maintaining investor protections and economic incentives to support long-term development and political stability, thereby establishing important precedents for international development assistance and investment protection. Constitutional and legal changes, acknowledging expanded government economic responsibilities, included the recognition of enhanced federal authority over economic affairs. This was balanced with the need to maintain traditional limitations on government power, creating enduring tensions between economic efficiency and constitutional constraints that would shape policy debates for decades to come. Ultimately, the comprehensive nature of post-war financial reconstruction highlighted the profound and permanent changes that wartime innovations in government finance and monetary policy had wrought upon economic institutions and political relationships. These transformations could not simply be reversed by returning to pre-war arrangements. Rather, they established the foundational principles for the modern mixed economy systems that would come to define developed nations throughout the remainder of the 20th century. The immediate reconstruction of the 1920s was merely the surface of a deeper sea change. Beneath the temporary fixes, the very DNA of global capitalism had been rewritten. The institutional and policy innovations forged by World War I financing laid the enduring foundation for modern government economic management. These developments established capabilities and precedents that would profoundly shape fiscal policy, monetary operations, and financial market development for the remainder of the 20th century, fundamentally altering the interplay between government and private finance. The war precipitated a remarkable transformation in central banking, moving beyond its traditional roles of maintaining gold convertibility and providing emergency liquidity. It established precedents for active monetary policy and expansive government economic management, creating robust institutional capabilities for economic stabilization and policy coordination that would become standard central bank functions in subsequent decades. Concurrently, government borrowing techniques evolved dramatically. Wartime finance pioneered mass marketing of government securities, sophisticated institutional coordination of bond distribution, and widespread public education campaigns. These efforts transformed government debt markets from an elite financial preserve into a popular investment opportunity, thereby establishing the bedrock for modern public debt management. Securities market development flourished from these wartime innovations, boasting expanded trading capabilities, enhanced clearing and settlement systems, and new institutional arrangements for government bond distribution. This robust infrastructure was essential for sustained capital market growth and enabled governments to tap into private savings for policy implementation. Furthermore, wartime lending and currency cooperation fostered new international financial relationships, setting precedents for policy coordination, debt management, and monetary stabilization that would shape international economic institutions for decades. Crucially, this period solidified the United States' position as the dominant international creditor and financial leader. However, this transition of global financial hegemony was fundamentally underpinned by a drastic divergence in real economic and industrial capacity. Between 1914 and 1919, European industrial production disintegrated under the strain of meteoric expenses and the physical destruction of productive capacity. For instance, coal production fell by 53% in France and 61% in Belgium, while iron production decreased by 83% in France and came to a near total halt in Italy and Belgium. Consequently, Europe lost its self-sufficiency and became entirely reliant on the United States not only for credit, but also to import essential raw materials, industrial machinery, and foodstuffs. Therefore, the massive war debts owed to the United States were not merely financial ledger entries. They translated these deep industrial asymmetries into durable financial hierarchies, structurally transforming America from a debtor nation into the world's principal creditor. But this global shift in wealth was only half of the story. For the true legacy of the war lay in the new invisible tools that governments now possessed to command their own domestic economies. Monetary policy innovations, breaking free from the constraints of the gold standard, introduced sophisticated techniques for managing interest rates, controlling credit expansion, and coordinating fiscal and monetary policies. These tools empowered active government economic management and provided novel means to address economic instability and unemployment, which had been unavailable under traditional monetary arrangements. The expansion of banking regulation, a direct result of government involvement in wartime financial operations, established precedents for comprehensive oversight and policy coordination. These frameworks would be further developed during subsequent crises, demonstrating how government authority over financial institutions could effectively serve broader economic and social policy objectives. Wartime mobilization significantly enhanced fiscal policy capabilities, leading to innovations in taxation, spending program management, and debt administration. These advancements enabled a permanent expansion of government economic responsibilities, while also establishing institutional capacities for social welfare provision and economic stabilization that would become hallmarks of modern democratic governments. Corporate finance also evolved, driven by wartime government-business cooperation. This period saw the emergence of precedents for public-private partnerships, government-industrial policy, and mixed economy arrangements, which would influence business organization and industrial development throughout the remainder of the 20th century. Financial innovation techniques pioneered during wartime finance, such as structured instruments, syndicate arrangements, and mass marketing methods, laid the groundwork for continuous financial market development. These innovations also created institutional capabilities supporting expanded government economic activities and private sector growth. Similarly, international economic cooperation arrangements, born from wartime financial coordination, established precedents for policy consultation, institutional collaboration, and crisis management. These frameworks would profoundly influence the development of international economic organizations and provide blueprints for managing increasingly interdependent national economies. Social welfare finance mechanisms, firmly established during wartime mobilization, created precedents for government provision of social insurance, veteran benefits, and employment assistance. These initiatives would subsequently expand into comprehensive welfare state systems, demonstrating how financial arrangements could effectively serve broad social policy objectives. Economic measurement and analysis capabilities were also refined for wartime economic management, including advanced statistical systems, forecasting techniques, and policy evaluation methods. These developments supported more sophisticated economic planning and policy implementation, fostering a deeper understanding of complex economic relationships. Innovations in educational and cultural finance, crucial for wartime mobilization, set precedents for government investment in human capital development, research and development, and cultural institutions. These financial mechanisms would influence social policy for decades to come, illustrating their capacity to serve broad societal objectives. Regional development finance, addressing wartime economic changes, saw government investment in infrastructure, industrial development, and rural economic support. These actions shaped regional policy and established frameworks for tackling geographic inequalities and promoting balanced economic development. Labor market finance arrangements, developed during wartime mobilization, introduced precedents for unemployment insurance, job training programs, and industrial relations support. These measures influenced labor policy and demonstrated how financial mechanisms could effectively serve employment objectives and social stability. Technology development finance, vital for wartime innovation, included precedents for government research support, patent policy, and technology transfer. These frameworks would shape science and technology policy, promoting sustained innovation and industrial competitiveness. Insurance market development, addressing wartime social needs, saw government involvement in risk management, social insurance provision, and public-private cooperation. This influenced insurance regulation and underscored how insurance could serve broad social policy objectives beyond mere private risk transfer. International trade finance innovations, supporting wartime commerce, included precedents for government export promotion, trade financing assistance, and commercial diplomacy. These developments would shape trade policy and establish frameworks for fostering international commercial relationships and economic development. Finally, constitutional and legal precedents stemming from expanded wartime government economic intervention recognized enhanced federal authority over economic affairs. While these established frameworks for government intervention, they also influenced constitutional interpretation and political relationships for decades, reflecting the ongoing tension between state power and individual liberties. The comprehensive transformation of financial institutions and economic policy brought about by World War I's financing requirements thus established the very foundation for modern mixed economy systems. These systems integrate private enterprise with active government economic management, creating institutional capabilities and policy precedents that would enable governments to navigate subsequent economic challenges while steadfastly preserving democratic political systems and private property rights. These profound innovations vividly demonstrated both the immense potential and inherent risks of expanded government economic involvement, simultaneously establishing the institutional frameworks and policy tools essential for managing the complex economic challenges faced by industrialized democratic societies throughout the remainder of the 20th century and beyond. The transformation of global banking systems during World War I stands as one of the most profound institutional shifts in economic history. It fundamentally redefined the relationship between government and finance, laying the bedrock for the modern economic management paradigms that continue to influence our world today. The era of conservative banking practices and limited government financial involvement that had defined the pre-war period was decisively replaced by revolutionary techniques for monetary expansion and resource mobilization, facilitating unprecedented levels of government spending and permanently altering the operation of money, credit, and public finance. The sheer scale of this transformation is difficult to overstate. In just 4 years, governments dramatically increased their spending by factors of 10 to 20 times pre-war levels, while simultaneously inventing entirely new financial instruments and institutional arrangements. These innovations mobilized resources on a scale previously unimaginable. The sophisticated techniques developed for mass marketing government bonds to ordinary citizens, the creation of unlimited central bank credit, and the seamless coordination of fiscal and monetary policies all established critical precedents that would profoundly influence governmental economic capabilities throughout the remainder of the 20th century. Perhaps most significantly, the war unequivocally demonstrated that traditional constraints on government spending and monetary expansion could be set aside when political necessities demanded. This established the enduring principle that economic limitations were not absolute, but rather mutable, subject to political will and perceived national urgency, of choice rather than as immutable physical laws. The rigid constraints of the gold standard, which had once imposed automatic discipline on both fiscal and monetary policy, were systematically dismantled. In their place emerged a system of discretionary management, empowering governments to actively pursue a range of economic and social objectives that had been entirely beyond reach under the previous institutional arrangements. These unprecedented banking innovations, born from the urgent necessities of wartime, laid the foundational groundwork for modern financial markets and sophisticated government economic management. The mass marketing of government securities, for instance, dramatically transformed millions of ordinary citizens into investors, simultaneously establishing the crucial infrastructure for broader democratic participation in government finance. Central banks, now unburdened by the gold standard strictures, gained the ability to create money, thus inaugurating active monetary policies. These policies were designed to combat unemployment and mitigate economic instability through deliberate credit expansion and dynamic interest rate management, tools that would become central to future economic governance. This era also gave rise to novel forms of global economic interdependence and cooperation. The intricate inter-allied debt relationships and the concerted currency stabilization efforts that materialized from war finance provided enduring models for subsequent international economic institutions, clearly demonstrating how financial ties could effectively serve broader diplomatic and strategic objectives. However, this departure from traditional financial discipline also introduced new dimensions of economic instability and social tension. The rampant inflation that inevitably accompanied unlimited monetary expansion significantly redistributed wealth across different social strata, while simultaneously cultivating a pervasive expectation for continued government economic intervention, an expectation that would profoundly shape political development across democratic societies for decades to come. The substantial debt burdens accumulated by governments during the war not only constrained immediate post-war policy choices, but also set powerful precedents for deficit spending, which would subsequently become a permanent, almost inherent feature of government operations. Interestingly, regional and national variations in wartime financial innovation highlighted how diverse institutional structures and political systems could adapt to similar profound challenges in distinct ways, yet often achieve broadly comparable outcomes. Whether it was the German universal banking model, the time-honored British merchant banking traditions, the newly established American Federal Reserve System, or the highly centralized French approach, each evolved to meet wartime demands while diligently preserving its unique characteristics and core capabilities. Beyond institutions, the human dimension of financial transformation during the war was equally profound, encompassing fundamental changes in individual economic relationships and social structures. Millions of people who had never previously owned securities became government bondholders, fundamentally altering their relationship with the state. While traditional saving and investment patterns were disrupted by inflation and the emergence of new financial instruments, the dramatic expansion of government economic responsibilities concurrently forged new forms of social welfare and economic security, thus reshaping the very nexus between individual economic well-being and political institutions. Looking at the long-term consequences, it becomes clear that the financial innovations born out of World War I provided the essential institutional foundation for virtually every major economic policy development of the subsequent century. Seminal programs like the New Deal in the 1930s, The widespread adoption of Keynesian economic management in the post-war period, the expansion of the welfare state in the 1960s, and even the monetary activism characteristic of recent decades, all demonstrably built upon the institutional capabilities and critical precedents established during the intense wartime financial mobilization. The inherently global nature of these changes led to lasting alterations in international economic relationships, establishing enduring patterns of cooperation and competition that would profoundly influence economic diplomacy throughout the modern era. The sophisticated techniques developed for international financial coordination during the war served as crucial models for managing increasingly complex and interdependent national economies, enabling them to collectively address common challenges and pursue shared objectives. Ultimately, whether we evaluate these far-reaching changes as predominantly beneficial or harmful depends heavily on our assessment of the inherent trade-offs involved. Between economic efficiency and political autonomy, individual freedom and social welfare, financial stability, and economic flexibility, the wartime financial innovations undeniably enabled governments to tackle pressing social problems and formidable economic challenges that pure market mechanisms had proven incapable of resolving. Yet, paradoxically, they also generated new forms of economic instability and political pressure that continue to powerfully influence contemporary policy debates. Understanding precisely how modern financial institutions and economic policies emerged from the crucible of World War I provides indispensable context for evaluating today's economic challenges and navigating policy alternatives. The institutional capabilities and precedents so firmly established during wartime continue to shape how governments respond to economic crises, while simultaneously influencing the intricate relationship between private enterprise and public authority in democratic societies. The banking system that financed World War I, in its profound impact, ultimately financed not merely a military conflict, but nothing less than the wholesale transformation of industrial society itself. It forged the institutional foundations for modern economic life, establishing the enduring precedents and capabilities that continue to influence how governments, businesses, and individuals navigate the complex and interconnected economic relationships of our contemporary world.